I think we have to appreciate it at the start of the year. We typically do see some of this last shall be first kind of rotation where the names that had lagged start to lead, at least for a short period of time. What's interesting is that actually started back in November. The rotation really kicked off in November because that's when we saw the blow off top and some growth shares. They traded to an 85% premium to value at the peak in October. So there was a lot of room for valuations to come in. And I think the character of this rotation has been one that's been very pro-cyclical. If you look at what's leading, it's things like banks, and you have industrials doing better, industrial commodities doing better. So it appears that this pro-cyclical rotation is coming with a narrative of global reacceleration, which I think remains to be seen if the data actually supports that.
Boy, I'm thinking about my inbox over the last, 6 weeks from the sell side and their 26 outlooks, almost universally positive, bullish, 10%, 12%, 15% expectations for S&P stock performance in 2026. That makes me nervous. Does that make you nervous at all?
There's not a single strategist who's expecting a down year in 2026.
Are you?
No. We expect.
Come on, I got to make some news this morning.
Look, we think that we'll have volatility along the way, but that there's still room for the markets to press higher through the end of the year. But the key point is that in the fourth year of the bull market, we've had 23 bull markets that have been 3 years over the last 50, 60 years or so. And the conclusion is about 50% of the time, they're able to get to that fourth year of positive returns. So we have a 50-50 chance of being able to deliver positive returns in 2026.
Earnings, I guess that's the good news for bulls out there because of the expectations are in 2026. Again, double-digit growth in earnings, 12, 13% growth in earnings. Is that enough to support this valuation, this market?
That has been what has supported the valuation through 2025. The fact that you saw the vast majority of returns in 25 driven by earnings growth, and that's expected to continue in 26. So if we break down the 2026 earnings number, it's $310 a share. That implies an acceleration in the top line. That's interesting because if you look at consensus forecasts for GDP, consensus is expecting a deceleration in nominal GDP growth. Remember, sales are nominal. Yep. The other important point is that you have over 200 basis points of margin expansion that's already being baked into current forecasts. So we think if we're thinking about what could drive markets over the course of the next couple of months, it's whether or not you take the over or under on that earnings number.
Cameron Dawson with NewEdge Wealth. We welcome all of you across the nation, including her Florida. We're doing Florida music today for Cameron Dawson. Do you know who Leonard Skinner is?
Oh, I was thinking you were going to go with Tom Petty, but yeah, sure.
Yeah, we have Tom Petty as well.
Yeah.
I just thought you were too young to know Leonard Skinner.
Yeah.
Yes, folks, we're going to play Freebird. Get over it.
I'm more of a simple man.
Yes.
Yeah.
Okay. I look, Cam Dawson, at this equity market. I don't see the exuberance out there. I know there's Robin Hood exuberance and, Lisa's kids are trading on the couch, but it's not like a 3-year double-digit OMG stocks are going up feel, is it?
And to support your notion of there being a lack of exuberance, you look at the Deutsche Bank and Goldman Sachs positioning indicators, and they're showing that institutions are effectively neutral. You cannot say that about households, though. Retail investors are max overweight, max all in. You've seen huge growth in margin loan balances. AAI positioning is at 71.2%.
Wow, I didn't know that.
That's back
huge.
to the peak from 2018 and 2021. So households are all in.
So institutions under-own NVIDIA?
Likely, yes, simply because they have positioning size caps. At the end of the day, when you have a market that's so very concentrated and you have certain mutual funds that cannot own positions as large as what some of these names are, by definition, they're institutionally forced to being underweight some of these leaders.
Fixed income was a great performer in 2025. What do you think about the bond market in 2026?
Yeah. So because we're starting this year at lower yields, we're actually in our strategic tactical asset allocations, I should say, actually taking some money out of fixed income and allocating into other areas, simply because you're not getting as much of a return as you were at the beginning of the year, given yields are lower and the strong performance that we've had this year. So we don't think that there's a lot of room for spreads to compress that
Right.
much further in high yield and investment grade. They're pretty darn tight.
Yep.
But note that they are 30 basis points wider today than they were at the start of 25. So
Really?
you
Okay.
can, in fact, squeeze blood from a stone.